Hey guys, welcome back. My name is Advait, and in this video, we're going to do Nifty Weekhead analysis. And as part of this, I'm going to be making one video every week and an update video if required, as and when market condition changes. Before we go into this week's analysis, let's first review the progress of last week. Now, if you've seen the last update video that I made, which was released on Wednesday, I said how Nifty was forming a bearish pattern with implied resistance at 17,150 levels. And on Thursday, in opening minutes, Nifty took resistance from that pattern and steeply moved downward. And when it comes to profit booking in this trade, it comes down to two things. One, the simple fact that on expiry, the markets tend to go sideways simply because it attracts both buyers and sellers who are actively making up positions for the coming days. And two, in a smaller time frame, you can see a support zone that is still active. And based on these two variables, had you exited at these levels, you could have gotten to right about 130 to 140 point move in Nifty on the day of expiry. Now, also in the update video, I talked about SPX 500 taking resistance from Fibonacci 50% retracement levels, and also how there was a possibility of a trap scenario on the upside. And on Thursday, it gave a strong rally and closed above the Fibonacci retracement levels. And on Friday, since the move was not warranted, it came down and closed once again below the Fibonacci retracement levels. Now, coming to the Indian stock markets, in terms of daily time frame, the resistance trend line that I talked about in the last weekend analysis series is still active. And in terms of hourly time frame, I said in the first video how in an early time frame we were following a channel pattern and we broke out of that channel pattern in the opening hours on Friday. But however, this move was not sustained and ultimately it closed below the resistance trend line, and therefore one can say that this channel is still active. But one more interesting thing I'm seeing once again is this blue resistance trend line, which I talked about in the first video as well, which is the monthly resistance trend line, as you can see here, how price is reacting at these levels. For you to make any long term positional trades, this area needs to be decisively broken out of, because if this area is broken out of, then a quarterly candle would have closed above a monthly resistance trend line. And therefore I was observing this as well, and I can see that in 15 minutes time frame as well, the market price is acting very choppy at these areas. So therefore it can be concluded that before you can positionally go long decisively, this area must either be broken out or broken down from. And in terms of zones for this week, we have support at 16400, 16450 levels, and resistance at 17150 and 17250 levels, and once again resistance 2 at 17500 and 17600 levels. Now, in terms of the news flow for this expiry, we have the WPI and Forex reserve data along with India export and import data, which came out on 14th, and also the passenger vehicle sales data came out on 14th as well. And that's pretty much it for India's news flow for this expiry. We don't have anything going on in the coming days for this expiry. And as far as international news flow is concerned, the federal budget balance was supposed to come out on 13th along with the US CPI. However, that has been postponed, and now that data will be released on 17th October. And UK CPI and Europe CPI are both coming out on 19th October respectively. The US building permits along with US existing home sales are coming out on 19th and 20th respectively. Now, just to give you a little bit of brief about all these news variables, the WPI data was positive for India as inflation, as far as the wholesale price index month on month eased. And as far as the Forex reserve data, we have slightly improved by less than $1 billion. And as far as India's export and import data is concerned, the exports have risen by $3 billion while imports have risen by $2 billion. making the trade deficit go down by $1 billion. And as far as the passenger vehicle sales data is concerned, it's very strong, month on month figures. And in terms of the federal budget balance, the deficit was $220 billion, and we're expecting it to be bearish going forward. And the UK CPI and Europe CPI, along with the US CPI, which came out last week, is expected to be bearish and show not much signs of recovery. The US building permits data is very interesting and also is an important indicator for you to track to know whether economic activity is expanding or contracting. And as far as the US existing home sales data is concerned, it also is an important data insofar as knowing the spread. And that's pretty much it for this week's news. And in terms of ratios for this week, the ratios that we used last week still hold true. This support is still valid. And once again, as you can see, the USD INR into DEXI has started increasing again. And CNX commodity USD INR. Guys, in fact, I made one detailed video about an important ratio between commodities and currency. I'll put the link of that somewhere up there. Go watch that video. I talked in detail about both this ratio and SPGSCI and DXY. Now, once you watch that video, come back and now look at this video, and here if you see this ratio, then it will make sense. See, this ratio is basically those two ratios, and we are subtracting SPGSCI into DEXI with CNX commodities into USD INR. So, what do we get from this ratio? We basically get the difference between the performance of commodities to currency between US market, which is an emerged or developed market, and we're subtracting that with India, which is an emerging market. Why are we doing this? Because India right now is outperforming the US, and this indicator is something that was useful in tracking the swing highs and swing lows as far as the past few choppy months are concerned. As you can see, it made a top here, and then as this started raising, Nifty started to go down, and it made a top here, and Nifty started to go up, and so on and so forth. So this is also an important indicator for you to track this week. And along with that, to track SPX movements, I'm using three ratios as far as this week is concerned. Guys, first of all, go watch the first video that I made on this channel, because there I'll be talking about the rest of the four ratios that I talked today. And in this video, we're going to be talking about these three ratios with a little bit more detail than those four. The first one is SPX into SPGSCI, which is the US stock market's top 500 stocks compared against the composite of commodity stocks traded in the US exchanges. Now, this is a 30% Fibonacci support levels, as you can see in the weekly time frame, and it is possible that SPX could temporarily take some support from these levels. However, if this is decisively breached, then the next place of halt would be at these levels, where once again if SPX could take relative support. And the next ratio that we're tracking is SPX into DXY, where we're comparing the index with the currency. And as you can see here, this is something that has been useful to track the movement of SPX throughout the past few months as well. And it has taken resistance from this level, and so this is indicating towards more bearishness in the short to medium time. And finally, SPGS, CI into DXY, and this I talked about in detail in that video. So please go check that video out first. And if you found this content useful, please do consider subscribing to that channel and liking the video. And thank you for watching.